Thank you very much for that introduction. I think that was almost as long as my presentation will be here. It's a pleasure to be here. I would love to be there in person, but joining today from Vancouver to discuss measuring the climate risk exposure of insurers. And we're advancing. So I won't spend too much time going over the paper just because I think that was a very clear presentation, and the paper as well reads very clearly. So the title of the paper really reflects what it's about. How much are insurers, focusing on the US, exposed to climate risk, where the methodology is going to be more broadly applicable. And the paper is super well motivated by the increasing cost of natural disasters, which may threaten insurers that are more exposed in the different ways that the paper discusses. So they're going to construct forward-looking market-based measures of physical and transition risk, where there are two key contributions coming out of this definition: forward-looking and the market-based parts of these new measures, which are also newly applied to the insurance sector. And as Huyen discussed, there are two primary findings of the paper. The first is that insurers with high physical risk exposure experience a decline in stock returns following natural disasters, and then insurers with high transition risk experience an increase in climate beta during the fossil fuel price collapse. So I'm going to make three main comments here, and then a few smaller comments, and I'm very happy to hop on a Zoom call later to discuss further, since we won't be able to chat during any of the breaks in the conference. So my first comment is related to how climate risk is defined in the paper, or more specifically, how climate risk exposure is defined in the measures that you're using. So as we saw, climate risk exposure is going to be defined here based on observed property damages in the previous year in the primary physical risk measure that the paper is going to use. The other is going to be based on insurers' claims for the 2000 to 2023 period. And so I've reproduced this equation from the paper, which shows that the physical risk is going to depend on the share of direct premia in individual states as a share of the overall direct premia earned by the insurer, weighted by the property damage in that state in the previous year, and then weighted by the insurer's market capitalization. And so there's a question here of whether risk exposure should be based on realizations of climate risk here, or the expected risk underlying the distribution in any given state. And so this measure is using risk realizations based on property damages or claims. And a defining feature of natural disaster insurance markets are that these risk realizations are very spiky and may not necessarily reflect the distribution of risk underlying those realizations. And so do observed damages in this time period accurately capture the distribution of climate risk, and is using these observed damages forward-looking here. And if, in fact, as the paper suggests, we do observe stocks responding to these realizations of risk, my sense is that maybe this suggests that underlying risk isn't necessarily being priced into the stocks if this is considered new information. So it might also be interesting, in addition to the risk realization measures that you use, including the same measure of physical risk, but using risk models. So First Street Foundation, for instance, has one for flood risk. The Climate Impact Lab has other measures that are going to incorporate other natural disasters, and you may be able to find others. And just to drive this home here, right here, I'm showing the time series of National Flood Insurance Program payouts from some research that I've done. And we can see here in 2005, Hurricane Katrina really caused a lot of damage. But then in 2010, there were relatively few floods. And so if we're always looking at property damage in the previous year, does this suggest that insurers are updating at that rate based on the tail event, Hurricane Katrina happening, or not? So it'd be interesting to discuss this a little bit further. My second comment is about market risk, climate risk market capitalization. So in the paper, you mentioned that these market-based measures are going to rely on the assumption that equity markets and investors are actually going to price climate risk. And so then I had the question, well, if we observe that your physical risk measures are actually responding to natural disaster events, doesn't this suggest that maybe they aren't accurately pricing these events? If this is considered to be new news, are people overreacting to tail events and so on? So again, there's this question of expectations and underlying risk distribution versus realizations of risk. And so I don't know that there's anything really to change here other than to a little more discussion of whether this assumption is reasonable, given that some of the literature seems to suggest that climate risk isn't capitalized into things like home prices. I've included one reference here. And so just a little bit of additional discussion and nuance seems warranted, and some discussion of how our interpretation of the results might change if this assumption doesn't hold, or if what we observe is actually an overcorrection. And these are the results from the paper, right? So we saw this graph of the insured premium factors actually responding here to a natural disaster event. So what does this say about this risk or underlying risk being priced in? My third comment then is about just readability of the paper. And this is something which hopefully will be easy to address. So there are many references throughout to your prior work, Young et al. 2021, for the definitions of sea risk, marginal sea risk, climate beta methodologies and definitions. And so I found myself kind of reading this paper with the other ones next to me and kind of cross-referencing when this paper that you presented today points to definitions that are elsewhere. And so there's a sense in which reading the paper suggests that you should be familiar with this other one. And so I think just including a section providing an overview of the methods in the other paper would help this one stand on its own a little bit more, and would also provide additional background. A few minor comments then. The first is just whether average annual property damage is the most appropriate definition of riskiness of states. So when you get to your validation exercises, Texas, Florida, and California are considered the highest risk states because they have the highest annual property damage. These are also the most populous states, so it might be interesting to look at a robustness where you consider per capita damages, which might better reflect relative risk across states. As well, there's a lot of discussion here about the signs of the results. So for instance, insurers with high physical risk experiencing a decline in stock returns following severe natural disasters. But it might also be interesting to include some additional discussion of the magnitudes. I wasn't quite sure about how to interpret some of these magnitudes, maybe in a comparison to other shocks, in addition to the signs. So this would be helpful for me anyway. So overall, I think this is a super interesting and important topic. I'm a little bit biased in this respect. And I think that this paper is a really important extension of what's a small but growing literature at the intersection of climate, finance, and insurance. And it'll be interesting to follow some of these measures over time to see if the insurance industry is actually able to adapt to some of these climate risks and take them into account. So thank you very much.
Thank you, Katherine, for your comments. I don't know if you want to react immediately to them, and then we will have some time for question and answers.
Yeah, just very quickly, thank you so much, Katherine, for your thoughtful comments. They are really, really helpful. And just to respond very quickly on your main comments, the climate risk exposure. So we are constructing the risk measure based on the previous year's property damage, and the mechanism we have in mind is that it takes time for insurance companies to adjust their exposure across the state. So the exposure is going to be persistent, and we think that the damage is a proxy of the riskiness of the state, but we completely agree that it's not a perfect measure. And I really like the idea to use the First Street Foundation and the Climate Impact Lab's risk model. I think that would be really helpful. And your second comment on the market pricing, so we are really capturing the unexpected shock. So it's the unexpected part of the shock after the part that's already priced in. And that's why we are seeing that the climate factor is declining when there was higher than expected shock. That's how we are thinking about it. And we will make sure to make the paper stand on its own. It's a great comment. And obviously, the Texas, Florida, and California, they are the largely populated areas. So that's why we tried netting out the premium. But it should be very straightforward to scale by the population. We will try that. And the magnitude, we are working on it. We completely agree that it would be very nice to connect the size, the magnitude compared to the natural disasters damage, for instance. And thank you so much. And I'd be happy to answer any questions.
Okay, I don't know if somebody from the audience have other questions. We have some time for that. And if you have, okay, Mauricio, please.
Congratulations on your very nice paper.
Thank you. Thank you.
How do you take into account reinsurance in your analysis? Reinsurance is a significant player in this market, especially for property and casualty, more than life insurers. So maybe the insurers in your analysis are not absorbing the risk, but that does not mean that the risk disappears. Somebody is absorbing it. In this case, a fraction of it, the reinsurers. Yeah. So because this is a conference on financial stability, we want to have a global view of how these risks are absorbed throughout the whole financial system. So that's my question. Thank you.
Thank you. Absolutely. We are working on it right now. And we were wondering if the low C risk actually has something to do with their reinsurance holdings. And we started working on the reinsurance data. We can observe what reinsurance contracts that the P&C insurance companies are holding. So we are getting there, but I do not have a good answer at this point.
Okay, please go ahead.
This is really interesting. Thank you. This is a related question on the property and casualty insurers and how they seem to be adequately capitalized for these risks. Would it be overstating it, or would a reasonable interpretation be that these large ones especially are pretty sophisticated companies? They're running all of these models. They're doing climate assessments. They're making these projections, and actually they're able, largely speaking, to price their insurance products correctly, and the market is just recognizing that. Would that be a fair interpretation, or is that overreading?
We want to answer that question, and I think Katherine's suggestion to look at the risk models of First Street Foundation or Climate Impact Lab would be really helpful to think about your question. We've been wondering whether the shock is really the news to the insurance companies or the market, and we were not able to distinguish that, and it would be very interesting and useful to know whether the market is the response coming from unexpected shock to the market participant or the insurance company. So we are working on it. Thank you.
Okay, please. Oh, sorry, let you after. No. Okay, okay. You and then you, please.
No, I was just wondering, I mean, this is not my field, but how common is securitization in relation to climate events? I mean, we all know the mortgage securitization, and we all know the IAG story back then in 2008. So yeah, that's just it's a general question. I would like if you could answer briefly how the securitization markets in climate events work. Or
So securitization, as far as I understand, I don't think it's very common. I think reinsurance contracts are more common. The insurance companies are reinsured, so the ultimate risk might not be at the P&C insurance companies, but they might be at the reinsurance companies. We thought about the CAT bond, the catastrophic bond that hedged catastrophic events, but we found that those are common only for specific types of hazards like earthquakes, so we don't think that's the climate-driven event, but we will try to understand what's going on if there is securitization market.
Okay, please.
So, beautiful paper, I really enjoyed it, and as somebody who's not in the field, I understood what was going on, which is really nice. The question I had is, what's been the response from insurers? Have you had a chance to present this to these companies and see what do they say?
So far, we haven't had the opportunity. I don't personally have any connection, but I would love to learn more about their risk models and how they are thinking about the natural disasters getting worse over time. And we know that in the US, in California, some insurance companies completely exited. So I would love to learn more about what they are thinking.